Hey, welcome back investors to another stock spotlight video. This week I'll be featuring the company Spin Masters, a North American company that produces and sells toys, games, entertainment media shows, as well as digital apps. This company has been around for about 20 years now, and its presence in the toy and children entertainment market is very strong. As always, with each stock, I'll go through their management, their balance sheet, financial statement, as well as short-term and long-term potential, and grading it out of 5 stars. And I will explain a few reasons why this stock deserves great consideration, especially in the next few weeks, on whether it will be a really good opportunity to buy in or not. So I hope you all will enjoy this video, and let's get started with the management. Starting off with the management team, we're going to look at Ronan Harari, who actually founded this company in 1994 together with his 2 other business partners. And together with this team, they actually have helped Spin Masters turn into this global leader in the toy, media, and entertainment markets, even helping them win a lot of nominations for innovative toy awards than any other toy company. So that speaks to their success in leading this company to different awards. Now, the hardest thing to do in a children entertainment company is adapting to changes, because there's constant fads and trends for children all the time, and their ability to adapt their products, to have a great design team, to constantly reinvent and innovate their products is absolutely crucial. And it feels like they've done that for like the past 20 years, and still today they are a very known brand itself, which speaks to their credibility. And with that, I'm giving them a 4-star out of 5 just because of this core group of management team. They also allow fresh faces to come in and provide strong contributions, so that's good to know. And as of that, there isn't much scandals and very questionable management decision making. Today, Toy Master is trading at $19.65 at a $2 billion market cap. Looking at its income statement, the first thing that jumps out is the total revenue. It's very consistent in the past few years. And as an investor, it's somewhat okay or average, because you want to see big growth in the company. And it feels like this has been a very stagnant company the past few years. As well, you take a look at their total expenses. In 2017, it was low, around $570,000, and then it's gone up every year, especially last year when it's at its highest. And that really ate away at their revenue right here. Last year they generated a very low amount of net income, $64,000. That's 2 times less than what they generated in 2017. That worries me as an investor, because you have to think about what happened, why the increase in expenses. And how they explained it is that they changed their manufacturing and production company, as well as their demand in toys. You know, children's toys are a very trendy product, right? They're not always in need, and they always follow a trend. So this year, especially with this virus situation, I want to see how well they do with the revenue. It's not going to get back to nearly this level, maybe hopefully $1 million, but what will they do about this expenses part? That's what I need to see in their earnings report, as well as what will they do to reinvent their product to still engage with children. Because during this coronavirus situation time, no one's going to stores to buy toys and games. Everything's online, which is still good for the company, because their portfolio still has entertainment media shows online, as well as their digital apps and toys. And that's very important for keeping the business still operating. And with that, I'm actually going to give this income statement a 2-star out of 5, just because there's some very alarming problems that needs to be addressed, and especially this year, how will they address it still remains questionable. Looking deeply at the balance sheet of Spin Master Corporation, we're going to start off with its cash. It's increased steadily the past few years, and in 2018 reached a high of 143,000. Last year it dropped from the all-time high to 115. Always more cash is more appreciated because it lets you do a lot of things flexibly with money. And their total current assets is around 760,000. It's increased a lot the past few years and is at an all-time high just because of their strong net receivable and inventory right here, appreciation. Now, along with the appreciation, you can look at their property, plant and equipment. That's gone up a lot since 2016 at a double pace. And that all together makes their total assets of 1.2 million for assets, which is at an all-time high. When you look at their total current liability, it's also it's a good amount to pay back, about 400,000. And if you compare that 400,000 to their long-term debt, it's actually incredible in that all their debt is basically current liabilities. So if they're able to pay it off, then they won't really have much current debt anymore or long-term debt, as you can see here. Total liability is about, say, 500,000. So 100,000 is long-term. 400,000, which is mainly most of it, is the current liability. So if they could pay it off somehow, that would be nice. If they can't raise enough cash, that's fine. They need to find a way to lower their their expenses. That's what it is. And they got to find a better way for cost-effective manufacturing and production. That's what I like to see. In comparing assets to liability ratio, it's 2-to-1 right here. A very comfortable 2-to-1, and it gives me confidence in investing in this company, knowing it won't even go bankrupt, as well as the ability to do a lot of things financially. Yeah, they're not strangled, and they have a lot of versatility with their cash. I'm going to give this a grading of 4-star out of 5. Spin Master today is trading at $19.65 and a $2 billion market capitalization. At its highest, this stock was actually trading around $40, and it's dropped to its lowest last month around $10 and rebounded back to $20 today. There's actually a lot of questions that affects its short-term potential, specifically its upcoming earnings report next month, when they're expected to lose around 14 cents per share. So it's going to be a lost profit quarter. And I need to hear management's plan to get this company back to at least 80% capacity. How are they going to handle the loss of their physical retail business? What are they going to do to boost up their digital business? Because stores are closed, what are they going to do about their digital business for them to earn back some revenue? And there's just a lot of uncertain questions that needs to be answered, and I don't have that question answered at the moment. Personally, I feel this stock right now is overvalued at its price. It should be around $10 to $15 range, because its business is nearly cut in like 80%, and most of their business is from physical toys and games. And there is actually a lot of digital app and gaming options that competes against this company digitally. So it's going to be a very tough ride for them. And it might take about at least 1 to 2 years for it to go back to full business. But all in all, I need to hear management's decision and upcoming plan to reinvent this company. That's what it is right now. That's the phase that they're going through. So I'm going to give a short-term potential rating of 2-star out of 5 for this company for all these reasons. For its long-term potential growth, I honestly feel this company will get back to its full business limits within 2 to 3 years. Kids will still continue to go to stores. Parents will need to find a way to educate them, and this is a great resource for parents to educate their kids, learning physically as well, using a mix of media as well. And as always, this product, as they have proven for the last 20 years, is very high quality, it's trusted, and is a very convenient way for parent to interact with the kids and also educate the kids. This product will never be out of demand because there's constantly lots of kids, and education is one of the most important things in the world. So having a service like this is essential for their development. Now, they could focus evenly on physical side and also as the digital side. Regardless, both sides are going to have competition, and what they seriously need to do is constantly reinvent, and that's what they've been doing ever since the company started, constantly reinventing themselves and staying strong in this market share business for children's entertainment. For all these, I'm going to give this long-term potential a 4-star out of 5. And thank you all for watching this video. I've done some good research on this company, and I hope I've convinced you in some ways to look more into this company and whether you want to consider investing in this company or not. And as always, do not invest in a company because I am investing in it. Invest because you feel this company has the potential and growth. Thanks a lot, and stay safe, stay healthy, and stay strong.